Anyhow, let's get started. This week we had some Fed minutes, some new Fed minutes, and I took down a few notes. Not that many. Usually I have more. But they talked, again, it might be appropriate to raise rates fairly soon. I took that as being a little bit more dovish than hawkish, because if they were really truly preparing the market for a hike in the next meeting, I think they would have been a little bit more explicit about it. I could be wrong about that, but that to me would make a little bit more sense. They're worried about expectations, that the market is starting to not believe that the Fed is going to raise rates and that could cause some type of a surprise. Oddly, I'm just looking if the website would pull up. Of course, it's moving slowly when I want it to be moving quickly. I was going to say what the percentage is. It's still a very low percentage. The market participants are not expecting much into terms of the Fed as far as them raising rates. So it seems to me that we may have a scenario, I call it the test tomorrow scenario, meaning you wake up and you realize that you haven't studied and that you have a test tomorrow, and the market freaks out and then reprices the risk rather quickly. I don't know why this isn't pulling up, the CME website. I had pulled this up earlier today, and I think it was something like under 20% probability of a rate hike. So the market is not really factoring much in terms of the Fed here. I don't want to cuff it. I want to give the exact number, and it's really pissing me off that for some reason their website might be down. That could be the issue. I've pulled this up before, but if there's any change in that, I'll discuss. It's been bopping around. My guess is that we go into the meeting and that there's some type of a reprice, that people may assume that there could be a rate hike a little bit sooner than not. They talked about fiscal policy, that if the new Trump policies pick up growth quick enough, it may force the Fed to move a little bit quicker than they would have liked. But they also, in an amazing show of Fed doublespeak, which they're used to, also mentioned that it could be delayed, and that could cause them to delay raising the rates in that regard. So the Fed likes to do a little bit of this push me, pull you type of a scenario. They talk about the foreign risk being diminished, but being the noble globalists that Federal Reserve bankers tend to be, I can't really see them taking Le Pen and all of these other, and the Merkel election and so on and so forth. I could see them being worried about that. So that, to me, could keep them, in terms of foreign risk, a little bit worried. And then, in an amazing show of being kind of a slave to the market, they talk about the dollar and their fear of the dollar going higher. We have an administration now, Trump doesn't want a higher dollar, and the Fed now is sort of blinked and say they don't want a higher dollar. So we know that if the dollar starts getting jiggy, that could make the probability of a Fed hike still lower. As far as the dollar goes, I've mentioned this before, that I said that this could be the biggest risk that the market faces in a while. And let's talk about it in big picture terms. The dollar ran up a lot, and now it's been pulling back. It's actually forming what could amount to here as a head and shoulders pattern. And if there was some type of a collapse in the dollar, I think it would be good for a number of asset classes. One, of course, being stocks, because S&P earnings, a lot of it comes from overseas, and then there's the repatriation issue. I guess the argument for the strong dollar is that foreign investors don't like to lose a lot on the currency, so you really need a stabilized currency. You don't want a dollar that's sort of in free fall. But anything that's below the 102 area, to me, sets up for a potential head and shoulders. I had said that I thought we would get a bounce. We had a look below and fail below the neckline that rejected higher, and now it's been having a hard time getting above the 50 MA. We had one close above the 50 MA a couple days ago, and after that, it's been troubling since. So I'm seeing the dollar is setting up as a potential head and shoulders, and if there's a neckline snap, that could go lower. That would obviously augur well for gold, and more importantly, silver, which is what I've been discussing. Today was actually a trend line break. If you look in SLV terms, well, not exactly the most convincing of bars. It's a bit of a doji. So, but we are above the 200 MA, and we did have a close above the downtrend line. So that, to me, is positive. I am definitely still a buyer of dips on silver. Silver is into the 50% fib, which has me a little cautious because it's up quite a bit. But like I said, I don't necessarily need to chase here. I would be interested in buying. I had started getting involved in this a lot lower when we had the inverse head and shoulders bottom, and then when we got up above the neckline. I had actually been in a little bit off the sort of off the low area, and then have been adding ever since. So that would be, I mean, obviously that's a good floor for mostly all commodities. Getting into, let's do the major market indices first. I think that's where the party's at. So today we had a gap up that was a quick liquidation break. And if you go back to my tweets, I had said that this was sort of a battle of the channels, that we had a situation where we had an up channel snap, and then we were sort of into a down channel. That down channel broke, but we weren't able to get back up above the backside of the old uptrend line. So I think that was a bit of resistance. And this morning, you had this little bit of a gap, and then I think you had the I guess gap fill crowd who comes in the morning when you have weak internal. Well, I shouldn't say weak internals. I should say more mild internals. When you have mild internals, the probability of a gap fill becomes high, and people like to take that trade. There are some people that just solely trade gaps in the morning. Anyhow, we had a quick order liquidation break immediately, which is no surprise. This happens quite often. My DM, which is my direct messages on Twitter, inbox started filling up with charts and projections and all kinds of stuff of, predicting Armageddon. And this is very typical. I mean, I get this all the time. I mean, everybody kind of knows somewhat to an extent that the market is extended and nobody believes the rally, and any downtick for more than 5 minutes, everyone has already got their, they're under their desks sucking their thumbs. It's funny, you hear all these talking heads come on television and they say, oh, if there was only a 10% correction that I could buy. Everyone's always looking to buy the correction, right? Until it comes, and then, like I said, it's under the desk thumb-sucking time. Everyone always says 10%, but then 10%, everyone says, oh, okay, I'm going to wait for 15, or I'm going to wait for 20, and then it's 2008 again. I mean, it's just, this is what it is. And what amazes me is I do survey after survey on Twitter, and the market is at all-time highs, and there is an amazing lack of euphoria. I keep saying this time and time again. It's amazing that we're at all-time highs, and nobody cares. I remember the last time that anyone talked to me about stocks. Sometimes doctors do. It's rare. Rarer still. Years ago, I remember during the dot-com boom, I'd be at the dentist and I'd be terrified that they were paying more attention to the ticker than they were to their work. Anyway, the last time I was at a professional's office, they were talking about buying gold, buying S&P puts, or asking about some of the usual tech stocks. I usually get asked about Apple or Facebook or once in a while, but I take cabs, less so these days. But if you're years ago, I remember every cab driver owned Sirius, or was asking about Netflix, or was asking about this or that. Nobody talks to me about anything. A couple of exceptions. I've gotten a couple of messages from some friends of mine asking me should they be investing or so on and so forth. But it just doesn't seem like there's that amazing market euphoria at all-time highs. Once you get the public involved, they sort of become the last buyer, the bag holders, if you will. And it just seems like there's probably some room to run in that regard. So today, anyway, we had this early move down, early liquidation break. It stopped with tweezer lows at 23.53 and then kind of rallied back up. I mean, what was impressive to me is that the bears had an amazing opportunity. You had a lot of weakness in some of the momentum stocks early. Apple was not up today, which keep an eye on that, by the way. If you start having multiple days of Apple underperforming, that is, to me, an early sign of market weakness. It doesn't always have to happen day one, but it could be if it continues. Google was weak, Facebook was weak, and all this stuff. And what surprised me, I expected to see TLT down big because remember, those stocks, the FANG names, love low interest rates. But that wasn't the case. Rates actually went down and these stocks had some weakness. So keep an eye on that. There's a lot of this, sector rotation. I think a lot of that weakness, though, had to do with a couple of earnings blow-ups that, I shouldn't say blow-ups, but moves down in big stocks that people have been chasing, i.e. Tesla and i.e. NVIDIA. People who own NVIDIA or Tesla probably own Facebook also, and, they all tend to trade, they tend to have a high correlation, these types of stocks. I see this Acacia is down big in after hours also. That might, I don't necessarily hold these as bellwether stocks. These tend to be kind of the silliness stocks, but maybe like Twilio follows. That tends to trade a lot with Acacia. We'll have to see if that's going to distinguish itself or not. Speaking of some of the silliness stocks, that Fitbit, which I remember arguing with people when the stock was 46 and telling them it was going to be a single-digit stock. Now all those people hate the stock, but I'm starting to warm up to it. So I had talked about the stock getting down to the 5s and 6s, and now that it's here, I have a little bit long, which has been working out a little bit well. Speaking of some of the kind of doggy stocks, we're going to get to those in a minute, but first and foremost, let me talk about SPY and the levels and actionable trades. I didn't button that up when we were talking about the overall trade. So I've done some projections, and people thought I was kind of crazy when I did them. And I had told people I thought the market was going to go to 234.03, which is the big 1.618 Fibonacci, is one of the big extensions from the Trump rally. And we had earlier reached the 1.618 Fib extension of the 2007 low to the, the 2007 high to the 2009 crash low. For some reason I deleted that number, but I'll go over it in the weekend review video again. Anyway, we're above the Trump rally extension, and I had said that we were above the channel, and it wouldn't surprise me if there was some kind of pause or lull or pullback. That really has not happened. If there were to be a pullback, oddly enough, the backside of the up channel, which we've now are trading on the top side of, would be the 1.618 Fib extension down at 234.03. I know everyone thinks the market is like massively overbought, but you have to keep in mind from 12.13 to 2.8, we were just in consolidation mode. You had a couple of tests, like 125 was a look above and fail. It had 3 days above and fail, and it came back down. So it seems to be that when the market has these breakouts, it has 3 or 4 days of consolidation, and then it could either go higher or fail. So now we have a 3-day range. Today's low never took out the low of the 235.51, which was the gap day from 221, and it kind of pressed back up. So it was a bit of a look above those 2-day range and then a hold of the low. So I see as a short-term play along above the 3-day high for still continuation higher, or if you want for a quick right or right out short below the 3-day low, which would be really below today's low, for a move down to the 10-day moving average, which is roughly around 234.25. talk about some other major moving averages. Where, if there were to be a bigger correction, where could the market go? This is what everyone keeps asking, and how to keep playing it. And the more they keep asking about this, the more that I'm thinking it might stubbornly stay high all the time, right? Like that song. So this is what I'm thinking. The 20 MA is down in the 231s and rising, and the 50 MA is coming in close to the breakout area here, which is 229.71 down to 228.34. That was sort of the breakout range. I'm willing to even give a little give down to 227.75. So between 227.75 and 229.71 is an important reference range, and I could see that area being a heck of a lot of support on a move down. So what's the best way to play this? People are asking. What I've been doing, and I explained this in the weekend review video, is that I don't know that a move down here would be very sustainable for long for a couple of reasons, and I'm going to list them right now. One is that we broke out. I mean, the market usually tends to break out, retest, and then at the very least have a bounce. I see that the first quarter of the year here is already up a lot, and there's been a lot of missing that of the hedge funds, although I have seen in some reports that they are now starting to pile in some more money, which to me, I guess, is probably a little bit more bearish. You don't want that, you want more money on the sidelines than you do into the market. But I see it like this. I see two likely scenarios for the end of quarter, and we're in a window now where there could be a pullback. So these are the two scenarios. One is that we get this, blow off top, and the market just goes completely parabolic up, and then there's an end of quarter lock-in, which sells off, which could start a summer correction. Or if there's a correction now, ahead of the end of the quarter, like in the next couple of weeks, there could be some end of quarter window dressing, which buoys the market back up. So how have I been playing this? We all know the VIX is low. Everyone wants to play this. So the only way I see to do this is to do put spread overwrites. I discussed this in a couple of other videos, but I'm going to discuss it again. I've been getting a lot of questions about it, and I'm happy to discuss it. So what I'm doing is, I know that I think that the market may come down at some point. It will, of course, at some point. There will be some type of a correction. But I don't know how near term it's going to be because of those two scenarios that I mentioned. So what I've been doing is playing a put spread and then overwriting it with still further below out of the money puts. So it kind of looks like this, right? I have my long put, my short put, and then more short puts. So what I'm doing is I'm doing longer dated put spreads and then more near dated overwrites because of the problem of the overwrite. If IV pops, that means price is going in the wrong way down, right? It's going barreling down toward that area. So yes, I'd be making money on the put spread, the one that I'm long, but the overwrites could come under pressure, and if the market comes down too hard too fast, that will come under a hell of a lot of pressure because I'm technically net short premium. So what the overwrite in a more near dated calendar allows me to do is to have the theta decay accelerate, the time decay is quicker, and it gives me the opportunity to defend the position. If that were to come down, I could either roll it out in that month and increase size, the more near dated month, or roll it down and out and either that or increase size into the month that I'm playing in. So I've been doing more longer dated plays. My camera here is in front of the... Oh no, here it is. All right. So I've been doing in like 57 DTE, 85 DTE, longer dated, like 234, like in May, the monthly, 85 DTE, 234, 225 put spread with a March 211 overwrite or a April 210 overwrite. Now the market keeps going up, and these puts start wearing down, and let's say the market doesn't go down, or doesn't go down enough. What I could do, excuse me, is take that 210 and roll it up to like 215, or wait until it decays enough, buy it back, and then go into the 85 DTE and sell those puts. And I discussed this in the video. I call these the green room trades. I don't want to go too much into detail of that, but it basically comes from Pool. You'll see me reference movies like The Hustler or The Color of Money very often. It's just sort of how I roll. I'm a big fan of big movie fan. So what does that mean? It means that I'm actually making money. This is as crazy as this sounds. In these short plays, I've been making money because of the overwrites. They've been expiring so much worthless, and I can rewrite them so many times that in many instances, I'm making more money on these overwrites than I am on the initial bearish play. So that's sort of like the analogy, where I come with the green rune play is when you go to like tournaments, pool tournaments. There's the tournament, and then there's the practice room games, which are usually for money, and then the pool hustlers make the money in the green room. They don't really worry so much about the tournament. So the tournament here is obviously the put spread, and then the overwrite is kind of the green room. So I've been playing this like green room game, but it's been working, as crazy as it sounds. And the bet is so cheap. It's such an asymmetric play for the downside. And look where the overwrites are. They are in truly big support ranges. You have to keep in mind that we're coming from all-time highs here, and that the market isn't going to just go into bear market mode without at least having, bounces or rally attempts. So I have a lot of confidence that the overwrites aren't going to be challenged without some type of event. I know the market is overbought. I know it's due for a correction, but how fast could this come down? Famous last words, right? How fast could this come down? If it were to come down tomorrow, let's just say there was some kind of disaster, the channel low is 216. 216 to 219, like really 217.03 to 219.60 was a true breakout area. The gap fill is down, of the entire rally is down to 209.55. It seems unlikely to me that we're just going to take out all of these levels in one fell swoop. So that's why I'm comfortable with the overwrites. That's basically what I'm talking about. What ratio to use long short put? These are straight out plays. Like let's say you're doing 10 and 10 and then another 10. Or, I'll keep it like 1, 1 and 1 or 2, 2 and 2 or whatever your size is. You can do it like that. I'm not getting too. What I would do with the overwrites, if we did get a down move and we did get a spike in the VIX into a support, I might add to the overwrite because I knew we'd probably get some type of a bounce, and I'd be playing that green room game with the overwrites. But I'm really using the overwrites as more of a cheap short. To fund a cheap short and to have on protection, because I have long plays on as well. And if there is like a sudden drawdown in the market, I need that short play to kind of offset potential losses in longs. So it's a game of playing for a cheap way of playing for a pullback and a very cheap way of hedging. So that's sort of the game I'm playing with the overwrites. If there's still more questions about this, please send me messages and I'll go over it again if I have to. But to sum it up, the idea is to have a put spread on, a long-dated put spread, and then overwrite still further out of the money puts into in a more near-dated series. So that and I gave a couple of examples. What you could also do if you're more of a short-term trader is put on the long-term the long-term put spread, and then you could play games with selling weekly calls or weekly puts to eat up some of the cost of that of that play. Either way is fine. I know people who do it either way. Successful traders in either way. Anyway, long story short, 3-day high, long above, 3-day low, probably short below for a quick pullback. If we were to lose 233.85, I would add to the short, because that to me would mean we're probably going to come down a hell of a lot more. Oddly, we had that 3-day range, and now we have another 3-day range. So we'll see how that goes. I actually thought the Bears had an opportunity today, but they kind of blew it. I mean, today was really an epic fail. They really had an opportunity, and they sort of, there was no seizing of the day. It was more like seizing the wood chipper. IWM, someone asked about IWM. That had a lot more weakness earlier, but kind of closed, where did we close? 138.75. The breakout was 138.82. So we closed a little bit below the breakout and right on basically the 10-day MA. The problem with IWM, if there's a pullback, the channel low is a lot closer here. If it were to go like in the next couple of days, it would be down in like 130, the high to mid 134s. We'll see how that plays out. I'll say this for IWM. Above today's high, I like long. Below the low, I like as a right or right out short to the 50 MA. It's interesting that IWM is softening. And I'll say why I think this is happening. Because IWM is a domestic play, right? That works really well, and when IWM was really in ramp mode was when the dollar was in ramp mode. Now that the dollar is weakening, I think that the money is maybe flowing back into the S&P, into more the cyclical names. So that's my thought on that. So I like playing against today's range for a quick short below, right or right out, and then obviously long above. I think that would be an interesting play, right? The Qs, this thing has just like kind of gotten a little hockey stick. Still holding trend though. You really need to see that trend. This broke out of the channel. The backside of the old channel is roughly the 1.618 also, or in the 128s, and you have a 10-day MA right there with a 20 fast approaching. So I don't really see this getting into too much trouble until you really lose 128s. That to me would be a lot more bearish. Let's get into some of the disasters du jour, right? Tesla and NVIDIA. So Tesla today was a gap and go trend snap to the downside. You broke trend and you took out 1, 2, 3, 4, 5, 6, 7, 8, 9 days worth of trade. No, I'm sorry, 10, 11 days worth of trade have been taken out. That's a lot. That's to me potentially a reorganization of the situation here. I can't say that I didn't see this coming. I had said that I thought we could see 306s if we had some type of a pullback really ahead of the number, but we didn't. And I think concerns of the capital raise started to come into the Tesla here. So where are we going? How low can she go? I'll keep it simple like this. I said early in the morning today that Tesla needed to hold above 265. Anything below there to me was vulnerable, and RTH never even was able, the high of the day was 264.66. And in pre-market, if you look, 265-ish was a bounce point. Anything below there, I don't even want to know about this thing long. Not for a while, at least. I would be more inclined. There was a reference level around 240.85, and then the fibs start coming in around 233.70 and then 221.02, which is roughly where the 200 and the 100-day moving averages are. The backside of the breakout, remember I had talked this being a trend line breakout, comes in a little bit lower here around 248. I could see this thing having like a doji tomorrow inside day, and maybe it waits for the 50 MA to catch up, but I don't really want to be long this until lower or above today's high of day. If it got back up above 265, I would look as today as a look below and fail. So I think you could buy stop over today's high, or if you want to play for the short, I don't mind a put spread or a put ratio for a move down closer to those fibs, or maybe even the 50 MA. The 50 MA was sort of where it really broke out from. But I know from past experience, and I've said this before, the 200 is really the key. So I wouldn't mind like some type of a put ratio or a put spread that brings you down closer to the 200 MA with an allowance of time for bounces and such. NVIDIA, I mentioned the other day that I thought the 50 MA was a right or right out buy, but also made the caveat that it wasn't really bouncing with gusto off of that break. Like it was a hammer, and then the next day was up, but then the day after sort of stalled at that range high that I drew in. And then today was a gap and go below the 50 MA, which I think really brought in sellers. So we're at sort of the consolidation range low here, which is 99.11, right? That was the last swing low. And then there was another reference low around 99.38. So this 99 area is very key. If that breaks, you really do have a confirmed double top in place. I don't think that NVIDIA is necessarily like done, but it may be done for a while. This reminded me a lot of another stock that traded a lot like this not so long ago, and that would be Netflix. You had a lot of instances. I want to go back in time. Let me go back in my Wayback Machine here. Netflix looked a lot like this. If you look at the 8.4 high to the 12.7 high, you sort of had this like pull back and retest, and then it just kind of bounced and went sideways for a long time before ultimately resolving higher, but it spent a lot of time in the wilderness in chop. I think that's what NVIDIA is going to do. I don't think this thing is going to completely fall apart. Again, I could be wrong, but I think this is going to just be really choppy, with the risk obviously being maybe to the downside here. How would I play it? What I think you'd be hoping for if you want to buy NVIDIA, like if you're looking to play long or if you're looking to play short, I drew in a Fibonacci retracement. And the 50% fib is basically to the breakout of 72.84. And the gap fill is just below at 67.66. And then the 61.8 fib is down at 61.49. I don't know if we're going that low, but I do think we are going to go to retest. Assume 99. Let's just assume for a minute 99s are lost. I think we'll see the backside of the old consolidation channel, the funnel, where we'd probably have an opportunity to play for a bounce, and that's roughly around 86s, 85s, 86s. I think that area is also a trend line support, another longer term trend. So that area to me would be an interested area. I'd probably there look to sell, depending on what the juice is like, some near dated out of the money puts. If you're short, or if you want to play short, what I think would be interesting would be to see it bounce first. I think there's a big temptation, and listen, it could just go, but we came down already now from 120. This gap down didn't happen from the top of the range. This is basically a move from the top of the range to the lower part of the consolidation range. And I think people might not realize that maybe options pinning and maybe just the fact that we're down 20 straight dollars could cause this thing to bounce. If we were to lose the 99 area, and I did a survey today, I didn't see what the results were. I asked which direction the next $20 in NVIDIA were. For those of you who follow me, I often talk about doubling the range. So if we were to lose the upper consolidation band, maybe the next 20 points are lower. That's just the way I'm thinking here. So 99s are a really critical strike. If it loses 99s it's probably going lower. If it can hold, maybe it bounces. If you're short or if you're looking to play short, the ideal scenario here would be for it to like kind of hold 99 for a couple of days and just not be able to rally, then break it. And then I think you'd get the articulation much lower. Or see some kind of like half-baked rally tomorrow, like maybe halfway into today's candle and then close on the lows, like have some kind of a doji, and then you could short it below the 2-day lows. Anything above today's high, though, to me, would be that it held the lower end of the range and then might want to come back up to fill the gap to the midpoint of the range. I'll go over this more in the weekend review video, but keep in mind, 99s, it's still okay. Below 99s, it's troubling. That's just my thought on it. So that's my take on NVIDIA. A little long-winded there, but good nonetheless, right? Let's cover Restoration Hardware. This was a bit of a, I don't even know if it was so much of a financial battle for me, but it was a little bit of a, I don't know how to describe this. It was a bit of a head fake for me. I got long this stock. This is the story with Restoration Hardware. Someone had asked me about it on the day it gapped down and it formed the hammer. Or maybe it was the day after. And you had these like 2 days worth of hammers. This was on 2, 7, and 2, 8. If you want to pull up your chart, RH. So I said I thought it was a long over the 2-day high, and promptly I bought it. The next day it went up, and then the day after it went up, but it had a downgrade from a research firm called Buckingham. And what was crazy to me, and I said I didn't think much of the downgrade, apparently the market didn't much either, because it went down and then it closed with a big hammer, a weak hammer nonetheless, but a hammer, that they still had a price target $20 higher. So you're downgrading a stock down at the dead lows, but you still have a price target $20 higher. I mean, what the hell are these people thinking? Anyway, I said anything over that day's high, which was 26.26, I would double my position, and I did. The next day was up, and then the day after there was a move up, and I was happy because I was long. And then the following day, I forget which firm it was, had an upgrade, and the thing had a big gap up, and I was thrilled. I saw the turn happening in the stock. The following day, it was up a little bit, but it was still acting weak. And then for basically 1, 2, 3, 4, 5 days in a row, the thing sold off. Now, I'll say this. I actually, as crazy as this sounds, I didn't realize today was their earnings. I'm sort of sorry I didn't. I wasn't really paying much attention to this, but today was their earnings. When you have something like that happen, when you have 5 days worth of selling, the risk is usually to the upside. And I happen to still stick with this. Why did I stick with it? It lost the low of day. It really lost 27. I probably should have been out of this thing at 27, and I had meant to be, but I think I was on something happened. I was busy. And I think I said to myself, if it breaks the 20, I'll be out. And I just didn't. I just held it. Why? So was this sloppy trading? Was this poor trading? It was more experience and just a gut instinct that the right move was going to be higher. Just because the stock acted well during a downgrade, and then any upgrade really did give it a move higher. It seemed to me that that there was the propensity, just based on reading the tape and getting a feel for the stock, that the stock wanted to go higher. No sooner than today, after hours, they reported and they had a beat and a buyback. And I think this company has actually gone private twice. So it wouldn't surprise me to see something like crazy like that happen all over again. So the stock is up in after hours. I actually wound up booking it for a pretty tidy gain here. I'm sort of having a little bit of seller's remorse, but I'll say this much. If we open up and we happen to get above 28.97, which was the high of day of that upgrade spike, I'll take that as a professional gap and assume that the stock is going to go a lot higher. A couple of pieces of loose change here that have me a little bit concerned is, and my original play was just to the 50 MA, was to be just to the 50 MA, and oddly the 50 MA is the backside of what would have been the uptrend line from that downgrade low. I'll show this in the weekend review again. So I used the pop to sell it. If we clear the 50 MA and close, there's a lot of reference sort of supply above. I do think that this could try to get to the gap, though, of 33s, 34s. I don't know that if we're going to fill the 39, but it wouldn't surprise me. But this area to me, if we could start closing above the 50, I'll get interested. Maybe I'll take some of my profits from shares and parlay that Pirates of the Caribbean style into some call spreads, or maybe risk reversal call spreads. The stock is now trading 29, where are we? Oddly at the backside of that, look where it's having trouble, at the backside of the old uptrend line. Not surprising. If this can clear 29.79, which was the after hours high, it's probably going to go still higher. You have 5 days worth of people selling and people who are short who are now wrong, 100% wrong. Don't you love that? You know, when you have two things going in your favor anytime you're trading. One is underlying conditions, and two are people who are wrong. So that is definitely in your favor. If this stock now, if I were going to use a stop, below 28.51 would be one stop, and then if you want to give it a little bit more room, below 27.5. That was really the gap of 27.45, and to that pullback low, or that secondary bar, was 27.5. So that to me would be the absolute maximum room I would give this thing, and I probably won't even give it that much. I forgot to turn the lights on in the apartment, which was pretty stupid. I'm right by windows, so I don't usually need them. That's way too bright. That's, I think, good enough. So if we get too dark here, I may have to, I could also turn up the computer screen volume. So that's my thinking with Restoration Hardware. We're taking too much time on these. Let me go through let me start banging this thing out a little bit more quickly. AT&T, I think they're doing a little bit better because of the merger possibility with Sprint and T-Mobile. Maybe that'll end the bleeding as far as the pricing goes in that industry. I still think that these companies like Verizon and AT&T are going to be under pressure because pricing is coming down and they're giving more, and it doesn't give them much of an opportunity to raise dividends. Verizon actually had a neckline snap, but now is back above it. I think that Verizon is looking to maybe fill the gap, but if this were to get back below 49.05 now, I'd be short, because that was the neckline, and if it's back below there again, it would be an absolute disaster in my view for that stock. So AT&T, listen, these things have big dividends. AT&T, the 200 MA is the key. If you were to lose the 200 MA, I'd be interested in short, but it seems like there's a bit of a move back into yield because it seems like the Fed might not go. I noticed that also, by the way, in some of these tobacco stocks. Take a look at like Philip Morris, for example, MO. That thing is parabolic. You'd think they'd cured cancer rather than be the ones that cause it. I mean, this thing has had a run from November, from the low at 61, it's almost 75. This thing is absolutely on fire. By the way, anytime there are larger market pullbacks in stocks like Philip Morris, PM also, this thing is up from 86, it's 106 now. Holy crap, that thing is unbelievably on fire. That's also one of my all-time favorite stocks, all these tobaccos. Anytime they get beat up pretty good, they are always places to hide out money. Nike is performing rather well as long as it held the 52s. It was actually kind of had a bit of a stutter step. I'm back in the camp of buy the dip in Nike. It had a consolidation funnel. It's now run up. I would expect there to be a bit of a pullback. If it breaks the 2-day high, it'll probably just still drift higher. I think it kind of has a 60 tramp stamp written on it. but I'd be interested in buying dips, more interested in selling out of the money puts, preferably 54 strike or below. Maybe the max would be 55s, but 54s was the breakout, and that's also the 200 MA, and you have 50 MA rough, closely approaching there. That's actually something I wouldn't mind tucking away in a bit of an IRA. Costco looks pretty bearish to my eye. This thing ran up a lot. You have 3 days worth of trade, so you have 2 days now worth of tails. If it gets above the 2-day high, it's probably a long, I shouldn't say unfortunately. I really have no axe to grind. I actually like the store. I like their products. It's actually one of the few retailers I actually like. My favorite, I think, being TJ Maxx, and maybe now that Restoration Hardware, since it paid us. I always get pissy when stocks don't do what they're supposed to do, which was kind of confounding me. Like, I had a lot of kind of like DMs that people pissed at me about RH, and now they're all lovey-dovey, right? Anyway, Costco is up a lot. Below the 2-day low is a right or right out short, probably for a play to the 20 MA, and the retest of the breakout of 169.73. I'd be more interested in this on a deeper pullback to the trend line from the gap. Let me circle this. This is really technical mumbo jumbo. I'll show you this in the weekend review video this Sunday, as well as Nike. People were asking me about US Steel, right? This thing is a mess, right? I mean, it's been up a lot, and then it's been just choppy, and today's range was nuts. I wouldn't be interested in it. Had a big extension or range bar today. I'd probably be interested, if I were long, I'd be looking to kind of sell bounces in this, maybe to the halfway point up to 39.14. That was really the breakout point. If you were to get a bounce there, I'd be interested in a right or right out short, and then an add below today's low. It's still above the 50 MA though. It seems like their business is improving. It just ran a lot. So this just might need some time to kind of to chill out, right, and consolidate. It's still above the channel high. There's if you do from the channel low to this like pullback, the pullback low, you'd be looking. I mean, roughly the 50 MA and the trend is around 34s. So this might just be a chopperooski. Like I said, if there were a bounce to 39.14, I'd probably be interested in a right or right out short with a stop above 41. But yeah, I mean, this to me just looks like it's going to be choppy for a while. It made a new high. It looks like a bit of a look above and fail, and those tend to sometimes have corrections. What is this? Someone asked me about Kimberly-Clark. Not one I follow very often, but looks like another one who found the cure to cancer with the way this thing has been trading. I mean, the stock is obviously bullish, but it's hard to now come into this thing. Like, the reference high was 138.87, and it's come up from the bottom. So I'd probably be looking to book profits in this on rallies, and then I'd be interested in buying the dip on this closer to the 200 MA. That had been the old support, which became resistance, and now should be support again. So Kimberly-Clark, I'd be interested in selling probably puts or maybe buying the stock down near the 200 MA. Same thing with Clark. Wow, there's a lot of moves into these. You know why I think these stocks are getting bids? Because of the Heinz deal. I think people think that Buffett is on the, he wanted to buy Unilever. So I think there's people saying what stocks look a lot like these, and these stocks have good dividends and easy earnings models. So if people want to be chicken hawk longs, they're buying stuff like this. Although after these things are up this much, I probably wouldn't be into chasing. I'd be buying dips. TLT is the same story. Someone asked about that. As long as it holds the 50 MA, it's okay. The must hold is the Fed day high, which was 119.21. As long as it holds there, I maintain that this thing probably wants to have some kind of a rally. If it gets back below there and below the 50 MA, just pull the ripcord and call it a day. That to me would be absolute trouble. We've been broadcasting a long time now, so I'm going to call it a day on that. I'll get into some more of the technicals on some other stuff. Oh, let's end on Facebook. because that's one I've been watching closely. I think Facebook's problem is that it came up from the bottom and the breakout is a little bit more suspect. That being said, as long as yesterday was a breakout of range, right? It took out the high from the earnings gap bar, which was 135.49. Anything above that to me remains bullish. If you were to lose the 133.46, remember the breakout was 133.5. That to me would have been a look above and fail, and you could probably short it for a pullback, maybe even to 125. I'd have to see how that plays out, but that's like the 50% fib, and at that point I'd probably be interested in a buy or to sell out of the money puts. But you have 2 days now worth of consolidation in that bar. If you were to lose those 2-day low, it's a short. If you take it out to the high, the thing is probably going to run, and it's probably going to run hard, and the run hard would take you up to the progression line, which is probably close to 150. Anyhow, that's the end of the story for today's video. The great news is if you came into this late, it will be on my YouTube channel as soon as it finishes processing, which should be soon. Anyway, I'm going to do a poll now on Twitter asking, do we prefer YouTube Live or we want Periscope? And the winner of that will determine our fates here as far as these videos go, whether we continue to do YouTube Live or if we go back to the fabled Periscope. Anyhow, I hope you enjoyed the new video. Please give me some feedback and cheers.